Hi, this is Francesco Nagari, Deloitte Global IFRS Insurance Leader. Welcome to our special IFRS 17 live webcast, 2nd of June 2020. We are going to cover today the very useful sweep issues that have been approved in a special edition of the IASB meeting, bringing the publication closer to its live date, expected to be at the end of this month. These refinements are helpful improvements of IFRS 17, and we can see one by one what they are and how the IASB got to them. For the agenda of the day, in addition to the usual highlights and detailed analysis of the discussion of the decision reached, I will also cover the article that was published by the IASB on why the annual cohort requirement in IFRS 17 should be retained unchanged. And then, as always, we'll spend a couple of minutes at the end on what the next steps are from now. In terms of the highlights, 2 meetings have occurred. The first one in April was not worth a webcast on its own, and it was an oral update where the staff provided the board with an update on the progress of producing the standard and confirming that there is urgency to get the job done by the end of June. The more substantial meeting was on the 20th of May, when the IASB approved unanimously nearly all of the sweep issues that were tabled for discussion. One was about the accounting for pre-recognition cash flows, other than insurance acquisition cash flows. Another one about the treatment of assets and liabilities for cash flows that related to a group of insurance contracts recognized before the group is recognized. Then there was guidance to be added for the inclusion as part of insurance revenue for amounts related to the income tax specifically chargeable to policyholders, a refined definition of liability for incurred claims and liability for remaining coverage, clarifications on how to apply the OCI option together with the risk mitigation option when you have variable fee approach contracts and the underlying items are held. And then a clarification on a topic that was particularly dear to Deloitte, B96C, clarifying that the experience variance from investor components will not impact the CSM unlocking, making it much more simpler than it was if the opposite decision had been reached. One amendment also very helpful on the allocation of reinsurance recoveries from a portion of a group of contracts that is onerous was approved with a large majority of 12 board members in favor and 2 against. And we'll see later what this simplification is about. But first, let me just give you a quick update on the oral update at the April IASB meeting. The first point was the staff reiterated the importance of an urgent, expeditious completion of the activities that the board approved for this month and the following May and June. The amendments are targeted to be released in published form in the last week of June. And the staff announced also that all of the educational material that has been published to date will be retained, but without further amendments. There will be a webcast that will bring out all the changes that the IASB has approved as a catch-all educational material to explain how to read the existing material prior to the amendments in light of the amendments published later this month. The IASB staff also confirmed that the TRG, the body that has been created in 2017, will continue. It has not been disbanded, and although it remains available for consultation, no further meetings are scheduled at present. However, stakeholders are welcome to raise any implementation issues to the IASB staff using the available channel provided in the IASB website, which includes the TRG mailbox. And if you have such issues as you read through the amended standard when it's published later this month, please do not hesitate to send an email with your problem to the IASB staff. Moving then to the sweep issues meeting, the first one I want to explain is this sweep issue on the accounting for pre-recognition assets, liabilities, and cash flows other than insurance acquisition cash flows. The staff noted that there was an unintended consequence from the text of the standard, which was restricting the application of a much more widely applicable principle with regards to cash flows, assets and liabilities that occur before the recognition of an insurance group. And that is beyond what was the insurance acquisition cash flows definition, which was based on the wording. So they are proposed and received unanimous approval to amend IFRS 17 so that now there is a requirement for an entity to include in the initial measurement of the CSM of a group of insurance contracts the effect of the derecognition of any asset or liability that had been previously recognized for cash flows related to that group of insurance contracts and accounted for in the financial statements before the group is recognized. So this graphic hopefully explains what we're talking about. There are assets and liabilities, for example, assets and liabilities you book because premiums have been received in advance, or you have been accounting for a liability that meets the definition of an acquisition insurance cash flows but without paying for it. All these will be recognized in the what is called the pre-recognition period. And then when you get to the point when the insurance group is recognized, you de-recognize those assets and liabilities because they now become part of the fulfillment cash flows. And that is now being clarified. So we have an actually very helpful practical clarification coming through that will make the paid versus incurred basis for expenses no longer a problem in our implementation work. Associated with this first sweep issue is also the second sweep issue, which gives us the treatment of assets and liabilities for cash flows related to a group of contracts that are recognized before the group is recognized. This effectively is the P&L side of the previous sweep issue. If you think about commissions that are incurred but not yet paid, that will create a liability under IFRS 9. If the commission is effectively due to be paid to the broker before the insurance contract group is recognized. So again, we're talking about a pre-recognition period. What this sweep issue does is effectively tell us you don't need to charge that to expenses, but instead you have the requirement to account for it as the pre-coverage insurance acquisition cash flow asset immediately at the same day as you are recognizing the liability. Those assets and those liabilities will remain in place as a pre-coverage, pre-recognition liabilities and assets, and then when the insurance group is recognized, the combination of these two sweep issues will effectively bring them into the relevant insurance group accounting. Fulfillment cash flows that are yet to be paid or settled will go into the fulfillment cash flows calculation at that point, and the liability will disappear, and the assets will be deducted from the CSM calculation. So all that creates then a continuum that is now comprehensive, doesn't leave any loose end, and gives us a basis which is preventing any flip-flop into P&L of the other side of the liability double entry. The next sweep issue is about insurance revenue amounts that relates to income tax specifically chargeable to policyholders. This is again another very helpful clarification following the changes in paragraph B65M of IFRS 17 that says that an entity is required to recognize the insurance revenue for the consideration paid by the policyholder for those income tax amounts in a manner consistent with the recognition of insurance revenue for other incurred expenses applying IFRS 17. The board has approved unanimously that there should be a requirement in IFRS 17 for an entity to recognize insurance revenue when the entity recognizes in profit or loss amounts related to income tax that are specifically chargeable to the policyholder under the terms of an insurance contract. So this is the illustration of the footnote that will be applicable after the amendment is published. You can see that there is in bold a new line breaking down the insurance revenue, showing amounts related to income tax that are specifically chargeable to policyholders in that period. That will feed into the total insurance revenue amount, which in turn will feed into the total insurance service result, subtotal. Obviously, this will increase the insurance service result subtotal, but at the same time, you will have in the income tax expense line item the amount that you are recovering out of the insurance premium. Now, it is my expectation that a lot of insurance companies will take the opportunity to use the subtotal breakdown of mandatory line items like income tax expense to present two lines at least, one being the income tax that is recoverable from charges specifically applicable to policyholders of the entity and other income tax. So that will give to the investors, the readers of the financial statements, clarity as to the portion of the revenue that recovers that portion of the income tax expense, albeit not within the insurance service result subtotal, but in two sections of the statement of comprehensive income. Nevertheless, I believe that this is transparent and clear enough for every investor to actually make good sense of the numbers presented. And so I would personally welcome this approval. The other sweep issue that followed was another clarification sweep issue where two definitions in Appendix A have now been revised because some respondents observed that the previous definitions would have left out certain obligations, creating a degree of confusion in how those cash flows would be captured, either in the insurance liability for remaining coverage or in the insurance liability for incurred claims. What we have now is a catch-all structure that allows us to understand how these obligations will flow through, first in the liability for remaining coverage and then in the liability for incurred claims as it goes on. And so this new definition will allow us to capture the pre-recognition assets or liability, investment components, premium refunds, and expenses payable to third parties. This is a helpful clarification. It gives us now unambiguous set of guidelines for P&L and balance sheet presentation, and the outcome of that is a very practical set of principles that I believe will make implementation a little bit simpler than it was before this was passed. Another sweep issue that I like particularly is this one. This is where the IASB realized that they were not intending to create an accounting mismatch between the OCI option being elected and the use of a risk mitigation within the same entity. And so they approved, again, unanimously to solve this problem. So let me describe the problem first. You know that the insurance finance income or expense line item can be presented by accounting policy choice either entirely into P&L or split between P&L and OCI. This deals with that particular choice. When you have made the choice of a split presentation, then you have an insurer that doesn't hold the underlying items, in which case the split between OCI and P&L is done by using the effective yield for the P&L part and the difference in OCI. But when you hold the underlying items, then you need to look at the underlying items accounting to create what is called the current period book yield method that effectively mirror images the amounts from the underlying items on the insurance finance income expense side, matching perfectly in P&L and OCI, the two opposites. Now, if you have a variable fee approach portfolio that has got 100% alignment with the underlying items in terms of the cash flows from the insurance contracts, you just use the current period book yield and you are almost certainly not using the risk mitigation because you got the perfect matching. But the reality is that in the vast majority of cases, less than 100% of the underlying items will actually match the cash flows from the insurance liabilities, because you will have elements of non-linearity to the fair value changes in the underlying items, having provided the policyholders with some form of guarantees. In that instance, when you use the current book yield, you will have to follow the underlying items and recognize, again, OCI and P&L based on the accounting of the underlying items. However, the moment you decide to apply the risk mitigation to take care of the risk produced by those non-linear features of your insurance contracts, you will have to account for all the changes in the fulfillment cash flows through P&L, because that's the requirement in the current text of the risk mitigation option. So what is the solution that the IASB approved? The board approved two changes. One, to specify that IFRS 17, paragraph 88 and 89 do not apply to the insurance finance income and expenses that arise from the application of the risk mitigation option. And the new requirements for that risk mitigation option will be set by specifying how to present the IFE that arise from the application of the risk mitigation option. And those requirements requirements will be effectively requiring the entity to follow the accounting based on the type of hedging instrument that you have used for the risk mitigation option. So if you use a financial asset measure, a fair value through profit or loss, or a derivative, then the presentation of the changes in the insurance liability must be all in P&L, and you effectively have a way out of the current book yield method. Instead, if you use reinsurance contracts held as one of the hedging instruments, then the same OCI accounting policy that the entity will have chosen for the mitigating reinsurance contracts held, being paragraph 88 and 90, will be used also for the presentation of the changes in the insurance liability that are connected with the reinsurance within the hedging relationship. So a very practical approach, very empirical, following the hedging instrument accounting treatment and effectively preventing the clash of the overlapping applications between the OCI option and the risk mitigation option requirements. Then we come to the one that I personally like particularly. It's the amendment at the last minute of something that Deloitte has been trying to convince the IASB for a long time. We got it finally. This clarifies and simplifies the accounting for non-participating contracts, non-VFA contracts to be precise, in terms of the experience variance coming from investment components. B96C will now be clarified to explain that the experience variance will not lead to an unlocking of the CSM, but effectively once you have taken into account the experience variance, which is deemed to be entirely driven by the different time value of money between the expected and the actual payment of the investment component, you will take that into the insurance finance income and expenses line item, and the undiscounted amount that comes from the actual payout compared to the discounted amount that you would have carried in the LCR, or vice versa if there was a delay in the payment that you were expecting. That would effectively just simply adjust the amount to avoid any consequences on the CSM to be brought through. And so that is what we believe was always intended, and we are pleased that the IASB has taken our input and the input from others into account, simplifying B96C to avoid effectively a complex spreading forward of the effect on the time value of money that came from experience variances on the investment component. So the CSM adjustment and unlocking is now effectively purely driven by premiums and the related cash flows and the insurance outflows. The last of the sweep issues, the one that was approved by a majority of 12 against 2, is addressing the use of a systematic and rational allocation method when determining the amount of recovery of losses from reinsurance contracts held. The staff noted that you may reinsure only a portion of a group of onerous contracts. And so that means that within that group there is a portion of the contracts in the group that are insured and another portion that is not. At one point you may have granularity that can tell you which one is generating the recovery from reinsurance and which one is not, or you actually may not have that level of granularity. And so that is a practical problem that will have to be tackled in IFRS 17 in order to allow a consistent application of the principle that the insurance recovery of losses has to be booked. And so what the IASB agreed with a majority of 12 against 2 is to amend 17 and require the use of a systematic and rational allocation method when determining the amount of recovery of losses from insurance contracts held in a specific set of circumstances as described above, effectively when you have a group that is only partially reinsured. So what you can see here is initial recognition in the blue box, in the blue call-out. You use a systematic and rational allocation method to determine the portion of losses of the onerous group that relates to the underlying insurance contracts. This means that there is effectively an approach that can be based on granular data or based on a proportional calculation basis. And then subsequently, you use a systematic and rational allocation method to determine the proportion of the subsequent changes in the loss component of the group that relates to the underlying insurance contracts. The final text you will see in the staff paper has been verbally agreed at the IASB meeting when the issue was approved, and our slide reports the text as amended through the debate on the 20th of May. And then again, just to be clear, the underlying insurance contracts are those contracts that are covered by the insurance contracts held by the entity that prepares the IFRS 17 financial statements. So these are all the SWIP issues, and hopefully that you find this account informative. So let me move now to the next item in the webcast, which is to tell you a little bit more about this article that Hans Högerwurst penned, and it was published on the 28th of April. It was a very controversial issue. As you know, EFRAG openly wrote to the IASB at the end of March asking the standard to be reopened. The oral update in April already gave very little hopes that this was going to happen. And then the article seems to have shut the door completely on that possibility. And now we seem to be navigating towards a final publication of the standard with the requirements for annual cohort intact. And that's why I felt it was important for me to explain objectively what is the content of this article, in particular to expand on one point. So the article is quite extensive. It's worth reading if you like to spend half an hour on this topic. It talks about the fact that most financial reporting requirements in IFRS are applied to an individual contract level. So the level of aggregation in IFRS 17 is already an exception to a general principle. And that's why that justification is correct and supported by the IASB. But they also believe that the level of aggregation at annual cohort is an essential requirement of the principle of aggregating contracts for insurance accounting. And there are three key concerns that the article goes through one by one, and I'll explain that in more detail in the next slide. But then the article also gives a little bit of description of the deliberation that the IASB went through to get to their conclusion that annual cohort requirement should be retained. So let's have a look at these three concerns that the IASB has talked about and what is the rationale that Hans Högerwurst has argued should be taken into account. The rationale you will see in a moment always comes back to this fundamental principle that the annual cohort is an essential element of IFRS 17 to enable prudent planning on how investors would determine the profitability of an insurance company, because the annual cohort provides information about changes in that profitability of an insurance contracts over time and allows the investors to have an appreciation of timely recognition of losses from the business that was written in the past. And so what are then the answers that come from this particular important principle from the IASB perspective against the three key concerns raised by the stakeholders? The first concern is, do annual cohorts fail to reflect intergenerational sharing of risks? And it's something that Deloitte also wrote in our comment letter last year. We were particularly keen to convince the IASB that intergenerational sharing of risk, in other words, the mutualization feature of certain contracts should deserve a particular exemption from an cohort as far as the unlocking of CSM is concerned. Obviously, that concern was not rated, and the reason Hans Högerwurst argues is that this mutualization varies widely across different contracts, and contracts that share all types of risks fully across policyholders with the insurer bearing no risk are very uncommon. And so the contention was always the fact that there is a portion that the shareholder, the insurance company, carries in its own P&L as well as the policyholders in their own. And so that means that there are significant differences in financial performance that can occur between different annual cohorts, in all of which the shareholder, the insurer, has got a share. And that is particularly true when you have minimum guarantees features in the contracts. The effect of these minimum guarantees is that the insurer in certain periods will be forced to actually pay for returns to those policyholders which are making that particular section of the portfolio onerous. And that is true especially when you are in an ultra-low or negative interest environment like the one we are experiencing today in many markets. If you are not accounting for the CSM with that specific annual cohort in mind, you're going to blend the effect of these onerous guarantees across generations where those guarantees don't exist, because in those generations the insurer may have sold the same type of contracts but with lower guarantees, and so they are still making good profits. What the IASB is arguing here is that it's actually important that those losses have to be recognized on a timely basis, and so they should not be offset by the deferred profits that come from other generations of insurance contracts within the same portfolio, even if the majority of the cost is shared among the policyholders. But once you have a shareholder share in that loss, then the mutualization is broken and the annual cohort requirement bites in the financial statements. There is also an argument in the article that financial statements will not be representing meaningful trends in profitability if you allow those guarantees to be effectively diluting their cost against the profit of other generations. The second key concern is whether annual cohorts result in an arbitrary allocation. Here the point is all around the subsidization, and that is recognized in the article as a fundamental principle of contracts with intergenerational sharing of risk. IFRS 17, Hans Hogervest explains in the article, requires the effect of this subsidization to be included in the measurement of the annual cohort fulfillment cash flows. The adjustments would be accounted for to allow for the changes in the fulfillment cash flows and the CSM of each annual cohort to depict the extent to which profit from existing contracts are expected to subsidize future or other contracts, or vice versa. So that is confined to the policyholder proportion of the loss. The annual cohort requirements is still there to effectively prevent that the mutualization is applied to the CSM part and effectively forcing the recognition of an onerous cohort if there is not enough CSM, but after subsidization is accounted for among the policyholders to absorb the shareholder share of that annual cohort loss. The annual cohort provides, therefore, in the article, is argued, useful insights about how management expects the business to develop. And that is a usefulness of information that IFRS 17 will protect going forward. The third key concern is whether annual cohorts are too costly for contracts with intergenerational sharing of risks. And the article acknowledged that although the use of annual cohorts adds complexity to accounting systems, the IASB concluded in their deliberation that these requirements are appropriate and the cost will outweigh the benefits of all this trend of profitability and early recognition of losses that they believe is useful for investors to know. And it is true also that if they were going to deal with intergenerational by eliminating annual cohorts, there will be different complexity coming in, but also resulting in loss of useful information. So in practice, annual cohorts may not always be necessary in calculation, although the IASB doesn't know and doesn't say how that calculation without using annual cohorts can be done. But they say if the respect to the principle of annual cohort can be done by a clever calculation that can bypass the annual cohort per se, but still producing the results of the annual cohort as if it is there, then methodology can evolve that can deliver that result at a less expensive cost for preparers. Clearly a target for all of us to work through this potential calculation, but at the moment not one that it is known to me at least. And that's the end of my account on both the meetings and the article. So let me just spend 1 minute on the next steps. The staff announced the publication is targeted for the last week of June, so stay ready for that. Deloitte will publish a recorded on-demand insurance webcast as soon as the publication is out. We'll study the text finally and analyze that all that we have been reporting back to you, webcast after webcast, can now be summarized in one nice comprehensive analysis of how IFRS 17 as published back in 2017 has changed to the new text, bringing out particularly the fine-tuning of the text that the balloting process will have created in the last few weeks, beyond what we already know as a result of the staff papers being published. So stay tuned and prepare yourself to download at your leisure. It's not going to be live, so it's going to be on demand. You can download it at your leisure as soon as we advertise the publication of the webcast shortly after the IFRS 17 text comes out. And with that, I'd like to land on the last slide and ask the recording to be stopped and open the floor for questions.